What is up, folks? Welcome to Kirk Trades. Alright, so I want to talk to you about the importance of the double bar entry. For example purposes, this is a back test. This is a paper trade to just show you the importance of the double bar entry method happening right now. Alright, so as you can see, this stock right here I found in my scanner. Okay, she was at the top of my scanner as the most traded and highest percentage loser. Now there are winners, but at these prices I prefer to short. And that's not to say that you can't buy if you wanted to. However, obviously the market is saying down. Alright, and if you're new to the channel and don't already know, if you don't know, this is the daily, hourly, 1 minute. This is pre-market post. Alright, so as you can see, we have a breakdown bar right here. We have a bar that's completely below this top. That makes it a top. Okay, because you have a bar that's below this top bar. Alright, and if you entered right here on that first pullback, that's somewhat of, there's a little bit of a pullback right there in the minute, you would have been in for an extra, what it looks like 12, 13 minutes waiting before the stock started to come back down. Alright, and basically you just need to find a bar that is below a top bar to really verify you can enter this. You can if you wanted to, but then you'd be taking a risk that the market is going up, that the market could go up. At least here you have an idea of, hey, we have a top. If there's a top, that means down. There's a bottom. Let's see, for this one right here, it's actually this breakout. You can trade that breakout if you're looking to go long and the market's saying up. Okay, so breakout, double bar entry. Okay, there's a breakdown, double bar entry. Now if you stayed in to the trade properly, and at prices like these you can actually get 2,000 shares. Why not? Daily looks great, hourly looks great. Why not get 2,000 shares of a $2.45 stock and make $400 on your trade? At this point right here, you have respect of the 50 all the way down until this area right here. And you can also get out at this 20. Okay, for the first time you have the break, you have the entry, double bar entry. Even before she goes down below the moving averages. Moving averages just give you an idea of where the market is looking to go. Okay, at least when you look for a top or some verified top, you can get in before the market evens. Before you have the arrow saying, oh, now the market's going down. Alright, so you can stay in till here. There's respect to the 20 till here. But if you really like that 50, which I would, I like that 50 a lot. That market is down. There is respect all the way through. On the very first time that the stock indicated down with the stock, there's complete respect. Just skimming along that 50. Why not exit based off of that 50? Excuse me. Alright, and as you can see here, you have a top. Okay, if you wanted to trade the daily, you could. For the first time, the stock is going down. And if you were to stay in, you could put a stock above here. Or, actually, I'd put a stop right there. There's a new movement within that 50. Or you could even put out a longer moving average and go based off of that moving average, just to cover that movement. Okay, and anything above the 8 here, you definitely want to start taking precaution that the market is going up. The thing about these moving averages, they give you an ideal thought process of where the market's going. On the 1 minute, you have the swings, but within those swings, you can definitely make money. Alright, so hopefully you guys learned something. If you were to swing trade this, you can put a stop right here. You can put a stop right there on the start of the new trend from off of this 50. But definitely right there at the 50 is where I would put a stop for tomorrow. Alright, like, sub, comment, and share.